Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So one of the brothers in the Discord have asked me to look at one of the companies they were interested in. So that's exactly what we're going to do. I've got a few more companies that I have been told to look at, inshallah. So I'm going to do that in the next couple of days. So stay tuned for that. If you like that type of content, please subscribe to the channel, and of course join us on the Patreon account, where you can actually get access to all the dividend calendars, ETF trackers, and then private Discord where you can actually talk to like-minded brothers who are sharing very good practices, mashallah, right now. So that's exactly what we're going to do. So if you have any questions, of course, as always, ask. So like I said, I've got another 4 or 5 companies that people have said or asked me to look at in the last couple of days, and that's what I'm going to do, inshallah, between now and whenever I get around to it. So inshallah, that's in the, so if you ask me one, I haven't done it yet already. I'm probably still researching about it, so inshallah I'll get to it. So let's get started with today's stock. That is Microchip Technology Incorporated. This company is right now, this is one of the companies that have been in kind of on my radar, but I've actually never researched about it. And if you own any device, so I'm talking about like your microwave, if you're talking about the fridge that you have, your dishwashers, whatever, they have a small chip in there, some sort of like what's called embedded system. So they take care of everything to do with the embedded system. So they create all these chips that go into those kind of devices. So they're very, very in terms of that basically popularity. If you know what I'm talking about, they are almost in every device. Okay, so that is just to give you in a nutshell. Of course, if you want to know more about it, of course, do your own research. But right now, as you can see, year to date is 28% up in the year to date. So that's for the 1 year, and year to date is actually up 30%. So it's gone up quite a bit. It has a PE right now of 16. That's forward PE, and dividend yield basically of almost 2%. As you can see here, seeking analyst and basically saying as a hold. Wall Street is actually saying as a buy, and Quants is actually saying as a hold. What we're now going to do is to give you a little bit more information about the company, and we're going to start with the financials just to see how this company, I haven't looked at this, so this is fresh to me. So as you can see here, okay, from 2014, we have data from 2014 to trailing 12 months. Okay, so 2023, I think this company has already reported the 2023 end of, okay. So from 1.9 billion to 2.1 to 2.17 to 3.4, 3.9, 5.3, 5.2. So it's nicely growing, apart from this year here, where there's a tiny bit of decline between 2029 and 2020. And of course, because of COVID situation, maybe that's the case. But 2021 onwards has also been increasing. In fact, there's a massive increase from 2021 to 2023, almost to $3 billion US, which is quite nice to see. And the trailing 12 months looks like it's actually even better. So in terms of revenue, is actually doing well. The other thing I'm going to look at in this side, there's a lot of information to look at, by the way, and the website I'm using, Seeking Alpha, you can go to Yahoo Finance, you can use like Seeking Alpha and so on. So as you can see in the millions to right now, 2.5 billion US dollars. So the net income is also growing. So bottom line is growing, the top line is growing, which is nice to see for this company. Now we're going to go back and look at now Simply Save Dividend. So this company pays almost 2% dividend. Okay, as you can see, the market cap is $48.8 billion. So it's a basically large cap company. And as you can see here, the dividend safety is borderline. So normally what we expect is 61 and above is safe. Okay, anything above that is of course very safe, and basically of course 99% is the highest that you can get. Right now it's 60%. Now if there's a lot more information about the company if you want to read about that, but what I'm interested is the payout ratio right now. So the payout ratio is only 23%, which is really decent. They have increased this dividend basically last full year 39%, which is quite nice. And the last 5 years they've been increasing about 12%, and the last 20 years 23%. So they are fast, basically very fast in terms of growing that dividend, which is quite nice. And as you can see here, it's been stable for quite some time, and then now they've picked up again. I think this has helped them a lot more than anything else. So let me see how often do they quarterly. Okay, so they pay May, June, September, and December, and you'll get $1.76 of every share of this company that you own. And as you can see, every single month is increasing. Right now, it looks like it is undervalued because the current yield is higher than the 5-year average. So that means the stock has come down a bit. But when you look at the 5-year PE, is higher than the 5-year average. So this kind of says basically it might be overvalued. So based on the dividend side of things, it looks like it's actually undervalued. And as you can see, the current PE is 20. And when you look at the information technology sector, it's about 24, 25 right now. Now, a couple of more things we're looking at. Okay, earnings payout ratio. Normally 50%, below 50% is what we expect. Okay, this company is 41%, and they have been actually paying it quite low, but the next 12 months is expected to grow basically almost a double but it's still below that 50% that we're after. Earnings per share has been nicely growing. Last 12 months is actually gone a little bit, but the next 12 months they're expecting to decline a bit. So there is a bit of a decline coming for this company. Despite that, it's actually gone up almost 30%, up 30% for the year since the beginning of the year, which is quite nice. Free cash flow per share is also basically there's a little bit of decline expected. If we look at shares outstanding next, okay, as you can see, it's been actually they're increasing for a while, but they have been buying back the last couple of years. Okay, so they are buying back again. Sales, total sales is actually increasing nicely. So from 1.9 billion to right now 8.94, which is what we've seen in that in Seeking Alpha. Return on equity of almost to 14%. Return on invested capital of 26%. Operating margin 39%. And free cash flow margin of 36%, which is quite good. And then net debt to EBITDA, we're looking about right now just above, just close to 2 for the next 12 months. We normally want below 1.5, but so it's slightly higher. Right now, it's just in that line right there. But next year, they expect in the next 12 months just to go above that. So with the company, of course, that's not a huge problem, but we're normally looking for companies that have a net debt to EBITDA below 1.5. So at least we know the company is not going to run into problems if anything happens to the company. Right, so now a couple of more things. We're going to Morningstar next. So as you can see here, there's 3 stars right now, and they say it's fairly valued right now. And the fair value price is 90, and right now the price is actually 90. So bang on exactly what they were expecting. The company has a wide economic moat. Let me just zoom in. It has wide economic moat. And the other thing I want to show you is trailing returns. So last basically 10 years, the company has returned total return of 16%, which is quite nice. Now, according to TipRank, it's a strong buy. But right now they're expecting a decline of 1.6. So basically they want their price target is 88, and as you can see here now is about 90. So a little bit above, about 1.5% from where it should be. Basically that's what they're expecting. Now, a couple of more things again. Next year they're expecting the earnings to decline about 10%. After that they're growing about 12% every single year for the following 5 years. That's the expectation. If we go back to Seeking Alpha, which is my favorite in terms of finding this kind of information, if we go to earnings and go to earnings estimate, so this is again an estimation, we've already seen that's closer to 10% for 2024. 2025 is a 9% decline, and then after that 18% an upside, and then 11% upside in 2027. But there's only one analyst looking at these 2 years, so I'm going to focus on the first 3. So you've got 2 years of decline, and then you're looking at it basically from there onwards it will actually pick up. Now if we go to ratings, we've already seen basically that it's hold but buy for Wall Street. So let's see what their price target is for this company. Again, more or less the same what we've seen with TipRank, because they are the same analyst. So about $80-90 from where basically less than 1% where we are now. So it's nothing huge. So again, 12 people have actually said it's a strong buy. 7 have said a buy and 7 is a hold. For that reason, it's actually a buy, closer to basically getting a strong buy. So again, when it comes to Wall Street analysts, these guys get paid to do these things, so you have to be mindful of that. Looking at profitability of this business, okay, you can see here you got the EBITDA margins, you got the net income margins, you got return on common. So you can pause the video and have a look at this, but this looks very, very healthy to me. So there's a lot of amazing things going on with this company. Return on common equities and so on. So they've been given either B+ or A+, or C is the only one that they have, and that's something that we've seen with the net income, net debt to EBITDA. Right. So again, it's a few more things in terms of valuation. Okay. Right now, the 5-year average for this company we've seen is about 16, and right now it's about 13. So it's below that. For when you look at the non-GAAP and GAAP, both of them, it seems basically they are actually lower than the 5-year average. So that kind of tells us it might be undervalued at the moment. Okay. Right, next we're going to just quickly check how it compares with the S&P 500, because when you're buying this type of individual stocks, you always want to make sure that they perform at least, similar or better than the S&P 500, because you're taking a huge risk, okay, buying individual stocks. Otherwise, you can buy one of the Halal ETFs. So what we want to do now is compare it. So let's just pick first total return, because that's the one I'm interested in. Total return is what I'm always interested in. And as you can see for the, let's go with 3 years. Okay, against the S&P 500, you can see it has returned almost 40%, and the S&P about less than 30%. So it is beating the S&P 500 in when it comes to the 3 years, and when it comes to 5 years, 170 to 90. So it's beating the S&P 500, and when it comes to 10 years, almost 400 to right now 160. So it's actually beating the S&P 500 massively. Now let's compare this with the direct competitors. So the companies that I know. So let's compare with these 3 companies here. Okay, so go Marvell, we've got NXPI, and we got on Semiconductors. Okay, so let's get rid of the S&P 500, and then again we will just use the total return as always, and let's look at the last 10 years. So in the last 10 years, we've already seen this one has returned almost 400%. Marvell has actually returned 377, so very close. NXPI is actually returned 472, and On has actually returned 937. So they are beating this company when it comes to the almost beaten, apart from Marvell, in terms of the last 10 years. In the last 5 years, again, the reason I look at the 10 years is when you're buying these individual stocks, you're not buying it just to hold it for a couple of months, whatever. You're holding it for the long term. Okay, 170, 280 something, 230 something, and 400. So again, it's actually down for the 3 years. Okay, almost 40, 32, 55, 160. So it's beaten when it comes to the last 3 years. So last 3 years, this company has done better than some of these companies. So overall, again, it's a decent company, nothing to really worry about, nothing to shout out about. There's a lot of people have actually on Seeking Alpha that are actually saying it's a hold right now. So they do believe it's a great company, okay, a growth stock with upcoming challenges. So you just need to look at some of the challenges. Again, these are some of the analysts that basically Seeking Alpha uses, so you might want to find out what some of these challenges are moving forward if you were really genuinely interested with this company. So what the investment thesis are, what they're talking about in terms of some of the things, some of the growth, where it's coming from, okay, the devices that they sell, who they sell it to. So there's a lot more research, of course, that you need to do. I'm not going to include all of that in here, but you can of course find some of these articles and look at their financials. So from 2021 to 2023, the difference and basically where the revenue megatrends are coming from and so on. So the 5Gs, the Internet of Things, the data centers, and so and so and so. So there's a lot more information, of course, you're going to have to dig into and find out, inshallah. But yeah, that's what I wanted to share with you guys. If you enjoy this type of content, like I've always said to you guys, it actually takes a lot of time to put these things together. I really appreciate if you can join us in the Patreon account to help me kind of keep going, inshallah. And of course, like the video, subscribe to the channel. And the platform I'm using right now is how to basically is giving out free shares. If you sign up basically for Trading 212 today, you'll get a free share and I'll get a free share. Have a wonderful day. Assalamu Alaikum.